Welcome back to Market on Close. I'm Oliver Rennick, and we've got 12 minutes until the end of a very positive session for U.S. stocks up. I want to bring in Charles Moon, who's joining as Senior Market Strategist of Equities at Prosper Trading Academy. Charlie, as always, great to have you here with us.
Thanks for having me, man.
We're going to have some fun. Scott Connor is joining as well. Here. The host of Virtual Trading, JB McKinsey, Managing Director of Futures and Forex at TD. So, Charlie, first let's talk about market overall. Seems like we're getting going to get a solid close to a very good day. It started off this morning and then carried through an extended post-Powell.
Yeah, that was so we're up slightly, right, in futures. It was a good response, nice bounce back. I think NASDAQ futures opened, or was right around 40, 50 points up at the open. And then right around that 9:15 click, we just started seeing risk-on moves. And some of these stocks were just, the stocks that were down 6, 7, 8% yesterday, they're up 7, 8, 9% today in some instances. And all these other stocks, and we started seeing it, like Qualcomm started getting some buying, Intel started finding a floor and started finding some buying. And then it's just
even NVIDIA.
Yeah, oh man, what a move today in NVIDIA. It's just straight up off basically the lows yesterday. And in essence, it just immediately became a risk-on environment again.
Yeah,
just like that.
A lot of the laggards popped today in a pretty big way. I mean, your biggest winners were not some of the companies you might think. I know that NVIDIA and AMD had big days, and AMD is definitely a higher beta type stock. But other than that, you had Mattel at the front of the pack. You had companies that had been beaten up pretty severely get big moves to the upside. It's kind of interesting to see that instead of this kind of high growth. In fact, value as a factor did a little bit better today than growth. I thought that was a little bit interesting in terms of where people ran to, especially if it was because of this so-called dovish catalyst.
Yeah, I mean, look, I think at the end of the day, this was when Powell came out and spoke here in Chicago. He made the insinuation that they would use a rate cut. I think the market said that rate cut is now in there. Now, what does that mean? I went for every over sort of beaten down stock, people rushed right back in there, and you're starting to see that push through. I think that's a good point where people may not have been looking. They were thinking, oh, they'll just go to the Apple, the Amazon, sort of the typical things, and they moved all over the place. I think it'll be interesting to see how much of this carries over into tonight's session as well. Do you get that same momentum overnight through the Asian markets, and then what happens into tomorrow's open? That's just very intriguing to see how simple little words from Powell were able to trigger a big push today.
And they weren't even explicit words, right? There was, and it was basically contradicted to some extent by Clarida right after, who said that they're not going to be beholden to market fluctuations.
No, but it is interesting. We were talking about the Fed yesterday and their dual mandate of inflation and employment, but what we also mentioned is that there's that sort of unwritten mandate that they have, and that's global growth and threats to the economies worldwide.
Stock market, just say it,
stock market. Yeah, but they can't say it. We can say it. But that's what he came out and said today. He goes, "That's what we're doing. We're watching. We're keeping our eye on, monitoring the tariff situation." And that, I think, just led more fuel to the fire, more confidence in the fact that a rate cut is coming, and how the Fed is actually justifying that in their minds. Because I think that's what a lot of people were struggling with. How can they really possibly, come forward with this big change in movement unless they've really got some solid data?
I mean, look at what happened in the Fed funds today, right? So if you go back to the beginning of May, it was a 66% chance of a rate cut, of one cut toward the end of the year. Then all of a sudden you got to 84% last week, like 91 yesterday, 97% today that you have at least one rate cut, and now they're posing a second one in September. Look how fast that just accelerated right through, where everybody went from saying off of some simple words or some tone, how fast they believe that changed, and then the market really flipped with it as well.
The history here is a encouraging, perhaps, thing to fall on, because in the past we have had these moments where markets get choppy, Fed gets our back, sky clears, and we're off to the races. Even if we do have this event in which Powell comes to the market's expectations, Charlie, and does cut, is it as clear as a path out as it was in, say, February 2016, right? Because we rocketed back into the growth, and it was new highs and clear sailing until January 2018.
Yeah, so for now, based on today's reaction, let's say the Fed moves forward and decides to actually cut rates, which in my opinion is almost ridiculous considering where the rates are right now. For my thinking, maybe from the retail side, maybe from the institutional side, is that, well, they did it once, maybe they'll do it again. And that leads to, just like today, a risk-on environment.
Right.
Back to normal, back to consistently up. I mean, the markets, in my opinion, were doing fine, and we still had people. We had people from retail to, the Oval Office starting to ask for rate cuts before it was even required, in my opinion. And we're not even in a situation where I feel that we need to have this cut in play, but yet we see what kind of response it draws. It draws from pretty much all across the board. We had a extremely heavy down day yesterday on high volume, and we wiped out those losses like that, and then some. We added on, we gained. So, it's
You're
like
impressed by today's move?
Yeah, well, I mean, it's typical, I guess.
Yeah.
It's just like everybody forgot about, antitrust lawsuits. Everybody forgot about the trade war, which is normal.
Yeah, and I wouldn't say it's all
Amazon was a little
fed
slow to
either.
get off the mat this morning.
Yeah, I wouldn't say it's all fed.
Right,
here.
yes,
I
yes.
think there's sort of a timing. A couple things came together, right? A few of the planets aligned. A lot of people who follow the markets kind of from a general standpoint, when they hear things like, hey, there was just a 10% correction in the market, that's the kind of headline that captures people.
Apple's down 7% in a day,
So
right?
for them, it's almost like an alarm going off, saying, whoa, 10% down, this could be a buying opportunity. So I think long-term investors tend to step in, and it brings back their attention to the market and what's going on. And they looked at this and said, okay, this is too much of this is a potential overreaction. This is where I'm going to potentially look into either add to my portfolio or take some sort of bullish type of short-term option strategy, for example.
I think this is a really important point, and actually, if we broaden out that chart for Apple, I think it's an important one that is nuanced as well, because if you then ask your question, all right, well, if this is the type of behavior that helps us, right, that comes in on days, it's almost like a dip buying mentality. The only problem is that dip buying for Apple and every other mega cap outside of Alphabet has not been powerful enough to set new highs, basically. So then today, when I look at a market that's up 2.4% in the NASDAQ, almost 2 in the S&P, that's great. But you don't really have some of these big mega caps out front, which is a little bit different, which is why I brought up the fact that it was more of a laggards move today. Because that's all fine, but you have to have a lot of stocks doing that consistently if you don't have big moves in leadership coming from the mega caps.
Yeah, this year has been way different. It was Google, Amazon, Microsoft, Apple, Facebook leading the way up, right? The only one that, Netflix, sorry, I can't forget about Netflix, but the only one that's really kind of sustaining even anywhere close to their upper portion of their range or their 52-week highs is Microsoft. Everything else has fallen on hard times. I mean, especially Apple and Google. I mean, my goodness, how could that not be a buying opportunity, even 100 points back?
$250 erased over the course of what, a month?
Not even
that, a couple
not
weeks.
even. Yeah, it really just took a few risk-off periods for that stock to just completely unravel, and it leads to the point like, well, what happened with Microsoft and their antitrust lawsuits?
Right.
It was eventually settled out. Microsoft really didn't have to do much. They were able to actually improve on what they're trying to do, and I just foresee the same thing with Google. I see the same thing with Amazon and Apple. These are great opportunities for the upside for the longer term.
I think that's an important thing, and the other side of the nuance from Scott's point is that when you have companies like Apple and Alphabet and others that can still draw, there's still these giants, right, that a lot of people will trust and happily pile money into when it drops 10%. To me, that also limits the downside of the market to some degree, because you still have these stalwarts that, while they may not be making new highs and they may not be generating the growth that they used to, they still command a pretty solid amount of buying when they do dip.
Sure, and we talked just a couple of weeks ago about how much cash that a lot of the big fund managers had put on the side. And so obviously there was a pile of cash on the side that was looking for a potential timing to get in. Now, I'm not saying they're putting everything back in the market, but when they see these 10% drops, they tend to start chipping away and re-establishing a position back in the marketplace. So that's one thing. I was also thinking that it was kind of interesting because there's a lot of really interesting cross currents today. You saw Bitcoin down 1,000 points today. So again, that's something we've been watching very closely, sort of as an alternative investment to volatility and the market direction, and you got a complete reversal on that today.
All right, hold that thought. We're going to get deep into that, okay, when we've got enough time to get JB in. JB, give me the last thought here on the market before we head to the break.
I just think it's interesting. I mean, look, Apple, Amazon, Facebook, they still haven't gotten rid of their problems. I think to Charlie's point, they still have the same problems. The difference was that it's that same idea. It got oversold, and people do, to your point, feel comfortable. The question is, where else are they going to go in? Are we going to start to see some of those other stocks that have been beaten in other areas start to climb up? Do you start to see a shift in some of the sectors? Do you get into more housing now? Do you get into maybe some other areas that had been beaten up a little bit along the way that now has a nice opportunity because now you feel that overall customer sentiment, we're feeling good that the economy is moving positively. That to me is why non-farm payroll on Friday becomes a ginormous number at this point, because now what's really out there in that marketplace is the job scene as strong as we think it is.
Yeah. All right. Nicely said. We're going to take a short break. Stocks are going to end near the highs of the session. A powerful day for the bulls coming back after a pretty sizable week to the downside. All right. It's only Tuesday. We got a lot of time left here, but right now we only got a minute left until the closing bell. We'll be right back. I want to bring back in our guests. We got Charlie Moon joining us, Senior Market Strategist of Equities at Prosper Trading Academy. Scott Connor, JB McKinsey with us from TD Ameritrade. To circle back real quickly, Charlie, on the big point for the day, which is this sharp response, a rally into the close now, a ramp nonetheless,
right,
that drives markets even higher in the final moments. Are we at risk of assuming that the past is going to be precedent again? And, coming back to this question about Powell, let's just say he cuts, say the Fed cuts. I mean, and the market gets it at once. Don't they want it because things are messed up?
Partially, yeah. I mean, I guess it depends on the trader that you talk to and the investor you talk to. For me, it just seems like people have been hungrily looking for opportunities on this down drop. And we actually saw, if you were watching really closely yesterday, just how strong certain Dow components were. I mean, in that risk-off environment. Disney was one of the names. Disney was basically just holding strong, and they finally broke out of consolidation, tight consolidation. It wasn't the biggest of jumps. I believe it was like, last I checked, it was like 1.4%. But nonetheless, they had held with the downturn yesterday when all three major markets turned down, and then only the S&P and Dow rallied while these big tech names are down. So when I kind of look at the risk-on environment, and I just see it pretty much macro across the board where everything is rallying, like JCPenney.
Yeah.
Groupon was another name that moved.
Right.
And so, it just like doesn't matter at that point. If people are looking for these opportunities, and the moment that we could see it macro risk on, and you had touched up on that point, like people miss this opportunity today. So when they're at home, coming home from work, they, flip on,
say, hey, things are
TV,
back.
and then they see this, and they're like, what did I miss?
Right.
So here comes all these limit orders flying in, and they're looking to get in because they believe this is going to be potentially sustainable.
We had a VIX move down pretty quickly. VXN also moved down pretty quickly given the rally in the NASDAQ. There's also just the idea of what has been front and center in the trade war got some relief too. Chips were up 4%. Even the most recent trade war entrants, we mentioned Constellation Brands, Diageo, some of the Mexican import issues and tariffs there looked like there was a little bit of relief. Of course, we didn't really get much news on the tariff side unless I missed something.
Right, and I think there's a little bit of confusion within the sectors today, too.
Oh, yeah.
Because you think if the Fed really is going dove, as we just heard, you'd think that would be bullish for what? Real estate and utilities. Yeah. But those are the two worst, those are the only two sectors, I think, that were down today. And real estate was down over 1%. So everything doesn't quite match up. I'm trying to figure out.
Well, this is, if I can just jump in.
Because I'm trying to figure out who's going into what. There definitely was buying. It was risk on. There were buyers for sure.
Oh, yeah.
But they were selective.
Well, this is a great question. This is why I was asking Larry Schober. I think it's one of the more important ones right now is if the Fed does get in line with what the market wants, what does that mean for the 10-year yield? Because there's this debate that I think is a very robust one that can go either way, basically, right? On the one hand, someone can say, look, market's asking for cuts because if not, we're going to get a recession. And then, so then if the market, it's very, you could really, I think, go both ways. So if we do get more liftoff and yield like we got today, even though the Fed is talking cut, given how much we rallied into this, it's like an extreme version of selling the news or something like that.
Yeah, what I thought was interesting, I was just looking up there, was the largest trade volume day product, 10-year. 1.8 million contracts traded. To give you an idea of versus the mini S&P, they're only at 1.7. So when you see that one, then you look at the second one, you look up there, it's saying to you the 5-year. Look at the 5-year pushing through there. The fact is the front half of that yield curve got a ton of volume today from a buying and selling standpoint, which is interesting because you really just said it was going to be a rate cut coming, and you had that pressure come off from the yield standpoint. But look at the pile that happened in those Treasury marketplace. To me, I'm very curious to see what's that directional trade that's on there. I think it's one of the things that come in a trader's report, something I may take a look at to see, because that's just kind of unheard of to see that much movement in there. I know it's a little bit of a future specific thing, but that's a bit of a move that you don't traditionally see.
You're seeing where the volume is focused across the,
Right.
the duration?
Correct. So normally you'd see that yield curve, you're looking there, you go further out there, and you're seeing that 30 barely had some trade movement on there,
I
the
see,
10.
yep.
Now all of a sudden
Yep.
you look at the 10 and the 2 and the 5, you see that part. And we talked about how that first half, the 2 and the 5 pushed through 2% earlier yesterday, and now all of a sudden it's probably come off a bit in that aspect. So the question ends up being is, did people pile back in because they feel that rate cut now is going to mean something, that we're getting out of that inversion, or what's there? To me, that's something to really focus and
Right.
take a look at right now.
No, definitely. Whether or not today is just a momentary relief from the trend or the start of something very real. If it's the start of something very real, you would think, Scott, to your point, that if we get more days like today, the utilities and real estates are in for a big time hurting. Because even though the Fed is talking cut, clearly the market's reaction means yields higher right now, given how much we rallied basically, and yields are pushed down into this. So it's kind of this bizarre situation given that the market moved so far ahead of the Fed in their expectations.
And you look at the move in the 10-year on a percentage basis, really wasn't that big. It was almost a flat day. Yeah, exactly.
Yeah.
So I think there's a little bit of a maybe sell the news type of scenario here, because 10-year yield and the bonds have led the way. They're way ahead of the Fed. Now, wouldn't it be interesting to see the Fed actually start to cut as the rates start going back up, if the 10-year starts climbing, or the yields start climbing, excuse me. So again, I would not be surprised to see that happen.
Yeah.
But yeah, you're right. I think that's what's a little bit of those cross currents we're seeing today.
Yeah. Charlie, let's talk about a few specific things here, because we're going to get some earnings after the bell here in just a moment. We're going to talk CRM. We're going to talk GameStop. Salesforce right now, actually, if we just pop into the chart, is up $5 in the aftermarket. And it looks like a revenue gain of about 24% and a fiscal outlook of 16.1 to 16 to 2.5 billion. So we'll see how the EPS comes in. The adjusted one right now, I'm going to wait to see what our data guys pull together on that, because it looks like there's a pretty big gap between what they report in the streets. I'm not sure if that's comparable. Are people still excited about a company like Salesforce, Charlie, or are they moving on? Are they trading the Twilios and Zooms Incs of the world?
Yeah, so, that's something that's been widely different from last year's trading environment to, let's say, this year's trading environment,
Okay.
where you would see the high growth names move in sympathy or at least alignment with like Adobe, with like CRM, with Boeing, with Apple, and the conglomerates. Well, the conglomerates just unraveled. But this year, we're seeing Twilio just inching on up, and Zendesk and Zscaler, and Roku is another example, and even beyond meat, BYND. What have they done besides like quadruple basically since the IPO, or at least
Yeah.
triple?
Yep.
And so it's just like people are finding opportunities. They're looking. It's kind of like the American way. I need it all now. People used to be more than happy to park money, look at it 5 years later, and see how we.
We're getting volatility again, right?
Well, and that's kind of what today could earmark too. It's not that we just get back into this ever-loving uptrend, because we're starting to see the range expand, because we've seen such a abrupt move from something like yesterday. It could be something similar to an environment we saw last August and then last November. Now, obviously, investors don't want to see that, because that's when the market's completely unraveled. But I don't think we're going to have that kind of volatility, not unless something crazy happens, most notably with geopolitical news, let's say U.S. versus China, U.S. versus Mexico, and that leads to this free-falling move. But seeing some back and forth, I don't think it's just going to be pure roses straight up.
Right.
It wouldn't surprise me if we're 300 points down tomorrow and then rally another 200 points, to end off the week.
Sure. Well, right before the December kind of collapse, that's what October, November was basically. There was a whole lot of back and forth in markets. I want to talk about some of the other big swings. JB, get us going on the Bitcoin stuff, because for me, one of the most interesting things about this whole market situation right now is we try and parse through what's happening in bonds versus stocks, and it gets to be kind of a mess. I think it is short-sighted when people ignore Bitcoin's role in this, because either you know, to me, it's either something's happening here differently than last time around that has to do with market structure developments, with interest beyond this thing as a trading tool, or option B, it is basically a repeat, and it is what we see in speculative bubbles where you have basically a second round that then comes back down. So if the thing comes back down, to me, it'll be an interesting sign about the risk appetite in our market, because it means that there was enough risk on that all this money came in. So that's, to me, why Bitcoin is really interesting to watch.
Yeah, I mean, looking right now, obviously it's sold off 10%, and people are saying, oh, that's it, that's the end. If you look at that chart there, though, you've seen these little movements along the way, and especially, I would say, over the last few months, where you've had sort of an acceptance, a little bit of a sell-off, you kind of do sideways, and then all of a sudden, you start jumping up again. To me, what's going on here is this is a market reaction. People found some other volatility, so I think some people took some money off the table and have adjusted potentially into some of the new areas we were talking about today, whether it was some laggards in stocks or some other opportunities. The question for here is where does it start to roll? What you want to see is some movement here. Does it start to sell back or buy back up a little bit, or does it continue down there? We've been in this about 3 or 4 times. Remember, if you go back a year ago, it was on its way down, and we hit about 9,000 right when consensus was, which was about a month ago. This time we were on the way up and we were 8,700. So now the question is, can you keep that forward momentum? It feels as though you're hearing a lot of items in the news about Bitcoin and associated coins with it, which seems more of that acceptance conversation that you were talking about, Oliver. So what you want to see is some follow through here. I think you want to see a stop, maybe it hits this technical level of 7,500 and then starts to bounce from there, or what happens from that next piece?
It's got to be pretty important, I would imagine, that either it finds some degree of stability, or if it just keeps on going. Because both those can kind of be construed as being, positive for the fundamental, side as the price goes up, liquidity, all that stuff, the health of the blockchain and more. If the thing starts precipitous moves again, or even just big 12, 10% swings, it's like, all right, to me, it's just like, there goes your store value argument again. If things get rocky in this market, I'm not going to Bitcoin to hide out, most likely, if I'm a big investor trying to hedge their money. I'm probably going to be looking at gold right now going 19 basis points up versus 1,000 down. I'm going to go with gold.
Yeah. Oh, especially if you're looking at what the Fed supposedly is doing now. So if they're bringing rates down in the U.S., what does that do? That tends to bring a weaker dollar, and weaker dollar does what? That puts upward pressure on oil and gold and the hard commodities. Not necessarily for Bitcoin. So you're absolutely right. If I'm an investor and looking at the two alternative choices of gold and Bitcoin, with Bitcoin up here and gold in an area where potentially, if the Fed does move in one direction, that should, at least you could make the argument, would put some upside pressure on gold.
Well, what's funny is that the Bitcoin people, as we've heard many times, will say, actually, that should be very positive Bitcoin too. In fact, a lot of the explanations for the run-up that I heard from folks in the community were, well, people are starting to realize that the Fed and central banks have no out. So I kind of joked last night when the thing crashed 10%, like, I guess central banks became responsible at this moment, right? Because that's one of the other things, which is, all right, well, if the Fed starts cutting rates and, gold zooms and Bitcoin doesn't, to me, it'll be interesting to watch that relationship between the two.
Sure.
Yeah,
What do you think, Charlie? Do you even pay attention to it?
I do. I absolutely look at, crypto, and I look at a lot of altcoins too, but definitely I pay attention to Bitcoin primarily because that's the focus. That's the face of crypto.
Did you say altcoin ETFs?
I did not.
All right, I thought, all right,
I just said altcoins.
Okay,
like Ethereum, like Litecoin, for example.
Give it time.
Stellar. But we've, over the last 2 years, slowly have been let's say before August of last year, became into more of a trading environment for the markets, being at all-time highs. People are very afraid of, in my opinion, putting risk on for too long. They're just more than happy to get it in, get it out pretty quick because it was pretty easy for them. And that's just really how I look at Bitcoin. I hear people say, I want to invest, but then they say, take out their money a couple months later. Yeah, I think people get confused between investing. It's because a lot of the people that play in crypto are generally brand new to the markets. This is one of their first investment assets that they've ever owned. So let's just say the younger generation, Bitcoin's going to swing. It doesn't trade on the same liquidity as, let's say, S&P futures.
Right.
It's not even close to that scale, right? I believe it's like 14,000 average per day for the CBOE futures.
But do you think I'm crazy to try and line it up somewhere along our spectrum of asset classes?
No, there's a lot of people doing it right now. I just don't.
It's a useful endeavor?
I don't think it fits that profile yet. I just think it's a trading asset like the VIX, or the VXX for now, for me.
Yeah, I think what's be interesting is you have this pull off of 10%, and using the conversation that Scott brought up previously, right? When Apple pulled off 10%, what happened? You had people pile in and say, hey, I want to look at this as an opportunity. So now does Bitcoin coming down here at that, I'm just looking here, 7,600 level,
that's an interesting point.
is this a point where now people say, oh, I actually think that sell-off is now an opportunity? Do they come back in? Or like you said, does it continue to have a slide down? This is the follow for you to see. I think if you watch it over the last 2 months, you're seeing more of a range where people are hitting this, saying, oh, I think it's now undervalued, and they jump back in. It works its way up, and then, again, going to Charlie's point, buying a little bit, get some risk, get some profit, take it off, and vice versa.
Yeah. Hey, Charlie, one thing I know you do trade video games, or, at least you play them. All right, and I do too, so I can call you out on that. We've got the GameStop earnings that are coming out right now. I was just going to throw it by. Have you heard of this? There's a new ETF. Obviously, there's a few out there. Gamers, one of them. There's a new one coming out. NERD, Nerd.
Right, I looked it up.
I don't know why they call it that.
I actually love that name, by the way. I absolutely love it.
It's all about the tickers now for ETFs. But is there anything in the space that's attractive to you right now? I mean, GameStop just got rocked again on their earnings. They're down to $7.19, so 70-cent move for them is like 10%. They eliminated their quarterly dividend. This looks like a total wreck again. Fiscal year sales down 5 to 10%. I mean, it's just...
Yeah, well, I think we talked about it last time, how GameStop's turning into Blockbuster, and that's kind of
100%.
That's really what it is. And they put themselves in a position where to attract clients, they pay way more for, let's say, trade-ins, trade-in value, and really just undercut their margin. And it's not a sustainable environment where they're at. When I looked up that ETF, it's heavily weighted by companies overseas.
Yes.
Yeah. I don't know if you noticed, like Korea and Singapore were like two of the top three.
Top country, top game.
ATVI is in there. What's really low in there was EA. TTWO is bigger.
People are scared of EA right now.
EA's been kind of just going sideways. They've held above 90. For me, EA looks way better than Activision. And out of the three, TTWO by far looks the best. But TTWO,
from a price action standpoint.
Right, and TTWO, well, just from a desirable standpoint, from dip buying standpoint, TTWO did become technical or rejected at the 200-day moving average about a week and a half ago. But prior to that, it was moving up really strong up to that level. And it was really leading the video game makers here. So
it's way above anything else in the space.
Yeah, so for me, it's like here, everything else is really soft. EA needs some sort of catalyst. I don't know what it's going to be. I love Apex, obviously. But for me, EA hasn't unraveled like ATVI as of yet. So they're just kind of going in the sideways pattern. TTWO is the strongest. I don't have any hopes for ATVI. And the new Modern Warfare is out. I loved how it looked, and I just know it's not going to do well. I'm going to buy this game. I'm going to play it. And
well, the franchise is it's dying out a little bit, man.
Dying out.
Yeah. Okay. we gotta run. Charlie and I will talk video games the rest of on our free time. But Take Two is doing very nicely. $109 at the close, 2.9%. We're going to talk more about the earnings here for GameStop and others in just a sec. Charlie Moon, always giving us a really nice breakdown of the market from your perspective, Charlie. Pleasure to have you back, as well as Scott Connor and JB McKenzie. Charles Moon is a senior market strategist of equities at Prosper Trading Academy. We'll be right back. Let's talk more about GameStop, what went wrong. George and I will do a little banter on how we think we could fix their company. But until then, we got to talk Salesforce because Mark Benioff's got a nice hold on that one, $4 higher in the aftermarket. In case you missed it, TD Ameritrade Network is now streaming after hours.
What, did you oversleep again? Or maybe you're just looking for the information you crave about the markets you trade.
Friends, don't let friends go slow. Watch Fast Market Replays on the TD Ameritrade Network.
Even though your day may be virtually over, we're still here, so you don't miss any of the market action.